Hi, this is Ashish Shanker, and I'm happy to present to you the June version of our monthly research publication, Alpha Strategist. It's been a very eventful month where we saw the final verdict of the general elections in India. The ruling party came back with a thumping majority. Our core hypothesis on the economy as well as markets remain unchanged, although stability definitely improves the sentiment a lot for foreign investors as well as businessmen in India. Essentially, what's happened over the last 3 to 4 years is there has been a huge cleanup of our banking system where NPAs reached close to about 10 lakh crores. A lot of the NPAs have now been provisioned, and we believe that we should see decent earnings recovery over the next couple of years, and this will be led by corporate banks. Near-term headwinds persist. There has been a large-scale slowdown in the NBFC sector as lending to this sector has been constrained, although liquidity in the system is reasonably good. What RBI has done in its recent monetary policies, they've cut rates and they have further reiterated that they will create liquidity as and when the system requires it, so that there is no systemic challenge. Market is becoming more discerning in terms of credit towards NBFCs, and a lot of the NBFCs who grew very fast through real estate or mortgage lending are facing challenges and are trying to deleverage. Now, this has obviously impacted financing to the consumer sector, and it is visible in slowdown across many sectors. We are almost through with the last quarter earnings season and the full financial year earnings season. The earnings season was actually pretty decent. It ended more or less on expected lines. For the quarter, we saw Nifty earnings inch up by 16%. For the year, we saw again one more year of single-digit earnings growth, close to 9%. However, we are quite optimistic about the next couple of years as corporate banks will lead the earnings recovery. We also see capacity utilization inch up across a lot of the industrial sectors and the investment part of the economy. So we believe those sectors should also contribute positively towards earnings. Consumer sectors are facing headwinds led by autos as well as staples. We believe that next couple of quarters should continue to be challenging. However, we should see things coming back on track, as consumer sectors are normally they face shallow dips and recessionary moments. So our core view is that one should take a 5-year view, as there is political stability and stay invested in Indian equities. In fact, one could even accelerate the pace of investments and get invested as of now. Valuations in the larger companies are expensive. They are stretched if you look at it from a trailing point of view. However, if you adjust it for the forward earnings expectations, valuations are slightly above average multiples. So going into the next 5 years of this government, I believe expectation in terms of returns from large caps should be muted. However, having said that, if one expects earnings to double over the next 5 years, even if you see a valuation derating on the larger companies, you'll still end up with a 12 to 13% kind of a CAGR, which is pretty decent if you consider that inflation now has come down to closer to 4%. So if you see real returns, they will be consistent with the long-term trajectory in equities. The real opportunity lies in the broader markets, especially in the mid and small cap space, because we believe that the valuations here are very, very attractive. If you look at the last 1.5 years, there is almost a 25 to 30% divergence from large caps in terms of returns, and a lot of mid and small cap companies are still quoting closer to their 52-week lows. Here is where the opportunity lies, and we believe one should look at increasing exposure to the mid and small cap space. We have recommendations which we believe will do well over the next 3 to 5 years. One of the clear messages in the manifesto of this government is that India is going to become a $5 trillion economy over the next 4 to 5 years, and they're going to do everything to facilitate higher levels of growth to reach this number faster. And we have a strategy with one of our partners, which is called ASK 2025, which is looking to invest in companies which will be very big beneficiaries of this move. And this could be a very, very high conviction idea in the equity portfolio. For fixed income income investors, yields on the government securities have come off. However, the corporate bond yields are still very, very attractive, and one can build a high quality portfolio with yields of closer to 8%. If one goes through mutual funds which have these kind of portfolios, you can still get between 7.5 to 8% kind of yield over the next 3 years. We continue to believe that this is very attractive given where inflation is, and we think that you should remain invested in such funds. It's still credit funds are becoming more and more attractive, where yields are closer to 9% plus. But we would still watch the credit space very closely and see how this entire NBFC stress gets resolved. And if that happens over this phase of this quarter, then it could present an attractive opportunity. But for now, please remain invested in very, very high quality accruals. And if you have credit funds in your portfolio, please get them reviewed by our financial advisor. We'll be happy to review it and tell you what to do around it. So we believe that the verdict that the people have given mirrors a billion dreams and aspiration as India heads towards a $5 trillion economy over the next 4 to 5 years, and we move from a $2,000 per capita to $3,500 per capita. This presents a lot of unique opportunity, and India will continue to be a bright spot for foreign investors. So even for Indian investors, there are many opportunities, and we feel the road ahead will be quite exciting. Thank you very much for listening.